Last November, we reported on the Retirement Income Review, which was commissioned by the federal government to do a really thorough examination of the retirement system and how well it's serving Australians. What we concluded in our 650-page report was that the Australian retirement income system is effective and sound, and its costs are broadly sustainable. However, it is complex. First, you need to think about sources of retirement income and about the three pillars that tend to deliver retirement income to individuals. First, there's the age pension. Second, there's compulsory superannuation. And thirdly, there are private savings. And as we said, the largest component of private savings is home ownership. And in fact, for most people retiring today who haven't really enjoyed the full benefits of superannuation over their working lives, their home represents a considerable part of their net wealth. The second really important thing, which people tend not to know much about, are what we call social transfers in kind, or effectively the fourth pillar of the retirement system. And that is health, aged care, tax concessions, other concessions such as travel, rates, etc. And our estimate was that that's roughly equivalent to the full age pension for everyone over the age of 65. Not well understood, and really a little bit of a problem, because for many people in retirement, the fear of those costs means that they tend to underspend, and it creates more complexity again in how people set about measuring their retirement income and their needs. So to deal with this complexity, one of the things that has been proposed, and in fact it was proposed back in 2014 in the financial system inquiry, was that we introduce a retirement covenant. And the retirement covenant is about providing assistance to individuals going into retirement to set themselves up. And ideally, in retirement, you want a reliable income stream, you want access from time to time to small amounts of capital, and thirdly, you want to have some kind of longevity risk protection so you don't have that fear always of running out of funds. The retirement covenant will come into place on the 1st of July 2022, and it will require superannuation trustees to provide information, guidance and advice to members going into retirement. And it's not really just about products, it's really about engaging with potential retirees, whether they're in SMSFs or whether they're in large super funds. And one way in which this will be done is through giving retirement income projections. Instead of people what their balance is all the time, telling them what their likely income is to be in retirement, how much age pension they may receive, how much they're likely to get out of their superannuation, and looking at those private savings and how they also can contribute to retirement income. This is a challenge for the superannuation industry because it will require a lot of engagement with members and a good understanding of where their members sit. And it's, in many ways, it lines up well with design distribution obligations that are being introduced later this year, and also APRA's requirements with regard to member outcomes. But indeed, it's not quite as simple as just defining cohorts, because in retirement, it's quite diverse. People have different levels of wealth, different levels of income, different marital status, different home ownership positions, and they do require significant guidance. A lot of that can be provided if we're giving people information and guidance along the way, so that by the time they get to retirement, it's fairly clear what they need to do. But there will always be some need for a little face-to-face advice. And it doesn't end at retirement. That's important to know. That's also a dynamic period of time. You know, at retirement, 45% of people are on the age pension, but by the age of 80, around 80% of people are these days, because superannuation balances are not significant as yet for most people. And we also have life changes. One member of a partnership may pass away, someone may need aged care. So it's quite a complex area. And one of the important things about the retirement covenant is to help people through this period of time and to make the best of their retirement and use their resources well.
And so to our final panel in this series of discussions, and having looked at all three pillars of retirement funding from the perspective of consumers and the impact on the broader economy, in this session we bring together all the various strands of retirement income funding: superannuation, the age pension and home equity, including the pension loan scheme, and look at how every arm of the industry can join forces to provide a comprehensive and user-friendly guide to retirees, including the role of technology and especially the potential impact of the retirement income covenant. The topic for this third panel this morning, or today, is longevity, a blessing or a curse, uniting the industry to fund an ageing population. With numerous investigations, studies and reports, including the Financial Services Royal Commission, the Aged Care Royal Commission, the Retirement Income Review and the Retirement Income Covenant, the retirement sector has been thoroughly investigated, reported and regulated. But the question remains, is the industry in good shape to really take care of our retirees, particularly in the glide part of their retirement journey as they draw down on their wealth? Providing holistic and easy to comprehend information has innate challenges. So as Australians increase their life expectancy, how will we care for a growing aged and super aged population? To introduce our panel, and in the studio with me today we have George Haramis, the co-founder and CEO of Fiduciary Financial Services, which delivers financial advice through a scalable digital platform, and Dr. Joshua Funder, who's former chair of Per Capita and founder and CEO of Household Capital. Joining us remotely are Professor Deb Ralston. She's Professor of Finance and one of the three co-authors of the recent Retirement Income Review. We also have with us remotely Stephen Riley, Chief Operating Officer of HESTA, one of the country's biggest super funds, and John Moroney, the CEO of the SMSF Association, representing the self-managed super funds. John is also an actuary by profession. So an enormous welcome to all. Thank you very much for being with us. Deb, if I can start with you, the Retirement Income Review made it very clear that people need better information, guidance and good, affordable advice tailored to their needs. Whose job is that?
Well, I think that it's a job for superannuation trustees. We will say that because in the course of saving for retirement, most people will have something like a 40-year relationship with their super fund. And one of the things that is really important is learning through that journey what your likely retirement income is going to be, and knowing that you're well informed along the way. It shouldn't be really getting to the point of retirement and then thinking about what am I going to do next. So it's very obvious that we would think about super funds being an important part of that. And I know John Moroney is here, and it's a little different in SMSFs because the SMSF members are the trustees themselves. So in talking to their advisors, they're going to need to do a similar thing. But one of the things that we really want people to do is to enter retirement feeling confident and happy about the fact that they are able to live a good quality of life and that they can use their resources. Too often, people are afraid to spend their savings because they're concerned that they'll run out of money or there will be huge costs involved. And if we structure our products right, we can give people confidence to know that they're not going to run out of money and that they'll be able to afford the comfortable retirement that they saved for.
Stephen, this is a topic that we've discussed in other panels, but there's a lot on the plate of the super funds.
There is, isn't there, Ali? But Deb's spot on, right? That everyone on this panel is trying to do the best they can for members who are looking at retirement and who are scared to death about just how long they're going to live. So I think one of the big challenges for us is that we know a lot, but we don't know everything. So it's a bit like that old fable of people feeling different parts of an elephant. You feel the trunk, you feel the tail, you feel the great big legs, and you imagine different things. The easy part for us is going to be the tech part, where we start to pull those bits of data together. The hard part is actually going to be working together so that we can deliver, really good advice, good help to members, so that, just like Deb said, people can go into retirement a little more confident and a little less scared.
And how do you make the super funds a little more confident and a little less scared to give that advice?
Well, we'll get to the retirement income covenant in a second, but in principle, you lay out a predictable, understandable, preferably intuitive approach to what we can and can't do. And I think it's fair to say we don't always have that.
Deb, let's go straight to that retirement income covenant. Is that what will answer that?
I think that there is some work to do, and I think in 2022 there'll be a major review of financial advice. We do need to streamline those processes, and we need to give trustees comfort that when they are acting in the best interest of their members, that they have room to be able to do that. I think over recent years we've had concerns, probably through the Banking Royal Commission and through some other litigation, that makes people a little fearful of doing what they really feel they should do. So we need to straighten that out, particularly the intra-fund advice, so that funds are able to do the job that they really need to do.
And just before I bring in others, Deb, if I can just focus on this retirement income covenant for a minute with you, because the position paper says that the income strategy expresses the broad action the trustees will take to assist their members. It does not consider the specific circumstances of individual members, and they're not required to consider other sources of income. So I suppose my question to you would be, what's your reading of the covenant and retirement income strategy? And is strategy another word for advice, or is advice something entirely different?
I think that really developing a strategy is not going to be easy. I think you can probably within each fund define particular cohorts, and that ties into other legislation such as the design and distribution obligations, and also APRA's requirements on member outcomes. But at the end of the day, I'm not sure that it's going to be possible to give as much guidance as you need without the ability to really engage on an individual level. And I think there are things yet to be played out in that space.
Josh, let me bring you in here. Do you see the covenant as a game changer?
No, it's a starting line, but it doesn't go nearly far enough. I think after 30 years of a system that's universal and compulsory, but still too focused on accumulation, a fund having a strategy and defaults for cohorts isn't going to deliver for the people who are in retirement, or there's 4 million of those, or the 5 million baby boomers who are in or coming up to retirement now. I think the retirement income covenant needs to go further and allow funds to deliver guidance broadly across all three pillars, pension, superannuation and home equity, and to be able to deliver an individual strategy to a member who's been at that fund for many years and is looking forward to a retirement for many years. If we can't as a system say that over the next 2 years we can't deliver an individual default guidance to bring somebody's wealth to bear on their future, we'll spend 10 years not doing it, and that's not good enough for the millions of people who desperately need that sort of guidance.
And before I come back to you, Stephen, on that question of individualised advice, George, what do you reckon?
Well, I was always taught to look at product as the last thing in any discussion with a client, an advice client. So I'm looking at the retirement income covenant and I'm thinking, There's a lot of discussion about product, which is good. We need more good structured retirement income products. There's a lot of talk about guidance. There's a lot of talk about different cohorts within super funds. But the bottom line is that when people come to the point where they're talking about retirement, thinking about how am I going to retire, what do I need, and they're looking at a whole host of different scenarios, you can provide guidance in a certain way, but at the end of the day, you will need to provide some form of advice at some point. It doesn't mean you need to provide comprehensive advice straight up front, but along the way, there has to be some form of advice that's provided, because clients get totally confused with the array of products and services that are out there in the marketplace, and they need the guidance and then eventually the advice to make those decisions that are relevant and applicable to them in their own circumstances.
So, Stephen, where does this leave the super funds? Because it's, I mean, how well placed are you? How much of a visual do you have on your members to be able to give more specific guidance?
Yeah, no pressure, Ali. Thanks very much. Look, it's a really interesting thing. Everything that we are doing in not just super, but financial services in general, is moving more and more towards more personalised, more contextualised experiences that are insightful for what's in front of a member or a customer right now. I think it gets interesting when you start to say, well, what do you need to do that, to try and solve that personal challenge that George talked about for an individual in a certain situation. I mean, we've got analytics to kingdom come, but it doesn't necessarily tell you about their household economics or what Josh is talking about with how much equity they've got in a house. There's a whole lot of developments. Open banking is one where you can see a way to doing that, but we need to give ourselves, we need to find a way to have this conversation with the member and or the customer, and I think that's the big challenge in front of us.
And before we look at how you might grapple with that challenge, if I can bring you in, John. I mean, Deb made the point that the self-managed super funds are in a slightly different position, but what's your take on this?
Thanks, Ali. Yes, they are in a different position because the trustees are the members. A lot of them do rely on financial advice from financial advisor, from an accountant, from a mixture. A lot of them don't have a regular advisor, and one of our roles is educate the advisors that are being used and also to directly educate the rest of the million Australians who have chosen a self-managed super fund to help them navigate the issues, and that will be an ongoing challenge because the system, as Deb said, is very complex and we need to navigate through. And while most of the retirees in the self-managed super sector may not be on an age pension initially, a lot of them will be by the time they get into their 70s and 80s, and so a lot of the complications there in terms of optimising drawdown of your own assets, use of private savings, use of home equity are quite complex, both calculations from an economic actuarial point of view, but also then the discussions, the conversations, the emotional elements that people have to deal with as an individual or a couple. Most self-managed super funds are two members, so it really is the couples that are planning their own retirement. So there's a lot of similarities and commonalities, but there's also issues that relate around the self-managed super fund is part of a broader discussion about household financial planning and the broad range of issues, which probably works best where there is a professional advisor, but that's part of the world. It's not all the world.
And John, and this is something we've covered in earlier panels, but those who have a self-managed super fund prepared to pay for that advice?
Many of them are. So, as I said, it's probably around 50-50 that have a regular advisor and are paying their accountant, who may or may not be fully or partly licensed, and or paying a financial advisor. Not necessarily all the time. It may be setting up an investment strategy, reviewing that from time to time. Others will be paying on a regular basis for product selection, monitoring of investment performance, looking at contribution strategies, looking at estate planning and the whole comprehensive needs of someone that is planning for their retirement, their family's retirement. And most people will leave money left over, even if not by choice. Most people don't know when they're going to pass away, and so there will be then the estate planning issues, which are an important part of it. So it's really a matter of working through where you can in an individual situation. Many people are prepared to pay. Research shows a lot are not prepared to pay initially for broad, comprehensive advice, and so I think we do need a system which is more more customer focused and can let people start trying to try advice, find someone they trust dealing with, where you can be assisted and guided and provide advice in a subset of what your needs are to improve the chance that you will look to that advice and support when it's increasingly valuable when you get into the more complex issues.
So if you look at that type of advice, Josh, do you remove products from that type of advice? I mean, how do you get it so that you're not completely down the rabbit hole of someone's personal circumstances, but you're more than big, broad brush, vague ideas of what you might do? Like, is there a balance here?
I think John points out an important point. 50% of SMSF members and about 25% of Australian retirees access financial advice. And that's expensive. It's probably pretty good. It's probably reasonably well regulated. And the focus of this conversation shouldn't be optimising the existing financial advice. That needs to continue. We really need to come around as an industry and deliver for the other 75% of Australians who enter long, healthy, active retirements without advice. So let's focus on those, and probably in your mind think about a single woman who worked all her life, was underpaid, and retires with around $100,000 in super and around 30 years to live. So if we can come together and solve for that person in Australia in the next few years, then we've got started. And let's not be perfect. Let's deliver something that works for 75% of people in roughly that situation, and then improve that over time. And then we've got an issue which is in accumulation, which has been the predominant focus of the superannuation industry for 30 years, and inappropriately so, given the objective of the system broadly is agreed to deliver retirement funding. It's pretty simple. You're in growth or you're in balanced. And you've got a job, you try and keep your job, and you try and buy your home. That's actually a relatively simple set of scenarios to deliver to members, and I think the superannuation system does that pretty well. But each retirement is actually quite different in terms of where people have savings and gaps, where people have needs in their lifestyles or are confident with what they've got. Now, we need to start with defaults amongst cohorts that can deliver enough personalisation and enough choice within the options that people really have, within the adequacy of the savings they have.
So that's retirement income covenant, is that what you're talking about?
The retirement income covenant needs to deliver some defaults on an individual basis to develop a strategy where people can get through retirement on $100,000 in super, presuming they own their own home, and they're going to get the pension pretty quickly during that retirement. There are all sorts of scenarios around that. The other thing to note here is that gap, providing guidance personalised to 75% of Australian retirees, is already happening. We have the tools. There's robo-advice. There's a burgeoning industry in delivering home equity as the third pillar. The Australian pensions means tested. It's pretty good. So let's not talk for the next 5 to 10 years about the theory of things that already exist, pushing them off. Let's find what is working now, put them together, deliver them, and then improve on that. So there's an urgency here that's lacking.
But I go back to that question. Are super funds in a position to do that?
So
who's going to fill the gap?
Yes. So super funds, we have a universal, compulsory, and widely trusted superannuation system. So those three preconditions mean that super funds should be the vehicle. Now, depending on your political views, you either love super funds or you hate them, and that shouldn't be part of the conversation. We have a group of universal, compulsory, and trusted organisations that should be a large part of the delivery, what Deb Ralston said. Now, at the next level, are super funds equipped with the legislation and the imprimatur to deliver advice? Some people would say they've got all they need now, and others say they need safe harbour. In the next 6 months, in the review in 2022, sort that out. If there's anything more that universal, compulsory and trusted organisations need to do to use the tools we've got to deliver to 75% of Australians before it's too late, let's sort that out.
Isn't that partly what we're meant to be doing today? We're going to try and sort some of that out. So let me bring in George. I mean, one of the key things, or the essential thing, is this can't happen without technology, can it?
No. The bulk of the population can't afford financial advice, traditional financial advice as it stands today. And the average plan would be around $4,000 to $5,000 up front, and ongoing it would cost you about the same. So that cuts out the great bulk of the working Australians. The only way to solve that problem is to use technology. And technology does exist today to deliver compliant, affordable advice. We do it through our business, and there are other organisations that also provide advice digitally.
We're talking robo-advice?
I don't like the word.
I would think robo is almost like a dirty word, really.
We provide personalised advice, as do other organisations.
But it's on an algorithm, basically.
The algorithm is the, if you like, the be-all and end-all. It crunches the numbers, it evaluates in individual circumstances. It runs multiple scenarios, thousands of calculations.
But George, in the language of the covenant,
yeah,
we already go beyond a cohort to deliver individualised, scalable advice.
Yeah.
So we shouldn't go back to providing cohort-based advice. We should say, how can we deliver scalable individual advice?
But there's a question of trust as well, though. And do people trust the algorithm?
Well, I'll tell you, the feedback that we've had is that they do. We ran some focus groups just before COVID. The big concern for us was, will people jump online? Will they jump on Zoom and meet with an advisor? Now,
and
COVID,
here we are.
and here we are, and lots of people have been doing it since. The feedback from the audiences that we put in place, and I was sitting behind the mirror, if you like, watching them, they had good and bad stories about advisors, and everybody has good and bad stories about advisors, and so do I, and I've been in the industry for a long time. But the bottom line for the participants was, if you're a rules-based industry, which we are, advice is all rules-based. You're either compliant or you're non-compliant. Then the algorithm should be able to deliver the outcome because it's not subjective. It does cover best interest. And the way we deliver advice is it's personal. It covers single topics. So we're not talking about a raft of different topics put together. It's one at a time. And that's the way most people in the group we market to, what we call the mass market, the typical PAYG tax client and the typical super fund member, that's our client. So technology does exist today to deliver compliant advice. The challenge that you've got is that no one has come out from a regulatory point of view to say, this is what you need to cover in your technology to deliver that advice, and we're okay.
You.
That's right, we're okay. Yeah, we're okay with that, George. And we have tried to speak to the regulators, but there's not a lot of comment about that. And I think super funds are also probably thinking the same thing. I mean, I don't want to speak on their behalf, but they're probably thinking, but gee, if we deliver this type of advice, is it all okay?
No, and we can ask Stephen that, but let me actually, Deb, can I ask you, I mean, do you think, what is behind things like the retirement income covenant? It's technology.
Yeah, absolutely. To deliver cost-effective advice on a wide scale, digital advice, which is the term I preferred, is, just about a no-brainer. And for the average Australian who has still a relatively modest amount in super, tend to own their own home, not a lot of savings outside of that, it's not a particularly complex issue to give them that kind of guidance. You need to know, are they likely to have the age pension? Do they own their own home? Are they single or a couple? And a rough idea of what they've got outside of super. And that can give you quite a high level of understanding of the best product to suit their needs. So I don't really think it's overly complex. And I don't entirely agree with the statement you made before, Ali, because the Minister's been pretty strong on the fact that funds are going to have to engage with their members to know these things. So I think we need a lot more clarity about this for a start. And I don't think super funds can do their job unless they can at least build that kind of profile on an individual basis.
So I'm just, the statement that you're not agreeing with, what is the level of clarity or vision they have on their members?
Yeah.
So they really but you would say they can do better?
No, at the moment, I think, as Stephen said before, it's very tough for funds because they have relatively little information on their members. And actually, I think it was the 2019 Productivity Commission report said that about 50% of funds have only about 2 data points on each member. So they really need to get this information, which you can achieve quite easily through a digital kind of platform so you know what you're talking about. It's no point guiding people into something that doesn't suit them. And so there are a few questions you really need to be able to ask. So funds need to have the clarity around that and be able to do that. And I saw a presentation from the Minister not so long ago, and she was saying funds, you're going to have to understand these things about your members. So we need the intra-fund advice regime that allows them to do that.
Just if I pick up on a couple of points. Firstly, fact finds and technologies to do fact finds are ubiquitous. The idea that a fund can't do a decent fact find, and most technologies do, on their customers, we shouldn't wait for that. Secondly, I don't think we need to specifically regulate the technology around advice because the principles and the rules are clear. If the technology delivers those principles and rules, we're fine. So I wouldn't secondarily regulate technology. Keep the principles, keep the rules, check that the technology delivers those. Thirdly, and I'll say this again, we are already delivering the pension with technologies in the private market, accelerating access to the government pension. We're already delivering home equity via the PLS through private providers with technologies. We deliver a fully digital customer experience to Australians over the age of 60. Many of them are 92 years old, telling Google to turn the radio down. They're on a conference call, on a Zoom meeting. There is no problem with existing providers providing access to all three pillars of their retirement funding, home equity, the pension and superannuation, digitally to old customers. It's happening now. So let's not reinvent it or wait for something that's already happening to happen. Let's put those pieces together. But there's a real focus here on getting something working and then improving it.
Yeah. And I agree with George. I think people are far more receptive to digital advice than they were in the past. Yeah. And there was a recent wide-scale survey from First Links that showed about 40% of people coming into retirement said, yeah, that's a good option.
Yeah. So let's talk to the people who are doing the doing. Stephen, back to you.
Thanks, Ali. Look, maybe if I go back about 5 minutes and you said a superannuation fund's able to do this, yes. Yes, and Josh has outlined really, really clearly that he's spot on. We do have the tech. Deb's data point about that super funds only have a couple of data points, I think the Minister was being a little bit naughty with that and was pointing at a couple of maybe older school funds. You look at a place like Hester, we have digital know-how that's world class. We have digital advice, digital planning tools that are absolutely world class. I'd say that the Australian superannuation industry, is one of the leading member experiences in the world. But if you listen to what Josh is saying, you'd think, well, we're there already. Why is this an issue? And it is still quite tricky to engage with a member without tripping over some of the landmines that have been put in place. And I think the Retirement Income Covenant is a good step towards that because it starts to say, hey, you can go there, you can ask these sort of questions because guess what? Something that we've always known, you need to ask these questions if you're going to help a member plan for retirement.
Stephen, how clear are the landmines? Like, if you want to change the regulatory structure so that this can happen, is it something that the industry is going to fight over for years, or is it really clear what needs to be done?
Look, I think there's an easy way, which is looking at the intra-fund advice, and that's the phrase that Deb used, and I think that just being a little more open-minded about that and saying, hey, this is what retirement's about, and you can ask questions and give advice about that. That's the part that we need to open up a little bit, because the danger is when you trip into this space that gets defined as personal advice, and this whole conversation has been about making our conversations more personal. You can see how you land there. You suddenly have a whole new set of rules, some of which are easy to meet and some of which are slightly trickier.
John, can I ask your thoughts on this?
Yeah, no, I think it is a tricky process of trying to get people to engage, first of all, to give enough information about the super funds, know about their superannuation information, but I would expect in most cases, and I've certainly been a number of large super funds over the years. I'm still in both my own self-managed super fund and a large fund, so I get to see and compare what information is available. to pick up the non-superannuation information and to pick up the information about a couple, I think is a bit of a challenge, but it's a challenge the industry is working on to try to get something which is fit for purpose. There are tools. ASIC through MoneySmart provides retirement income calculators. Like most tools, they probably can be improved, but I certainly support Josh's view that it's best to get out there and use the tools we have and try to improve them over time. There has been criticisms of some of the restrictions from ASIC and from the law that prevents some innovation happening in terms of trying to use more in the way of digital support to enable things to be done that don't cross the line into falling foul of some of the personal advice regulations. So it is tricky to navigate, but I think the review that the government has announced the Treasury will do next year on the quality of financial advice is a crucial review to enable to get a better outcome for the next 5 or 10 years. And I fully agree with Josh, we can't wait for too many there, but we do need to improve the framework within which super funds, advisors, accountants are working so that we can help look after not just 75% that are getting very little, but to improve the efficiency and the effectiveness for the whole population.
There's a big landmine that I think is also, I don't know if Stephen was feeling for an elephant by its tail and trunk and legs before. I don't know if this is the landmine that is the elephant in the room, but members' best interests and whether that can be successfully delivered by only considering superannuation, which for 75% of people who don't get financial advice isn't going to fund their retirement. And whether super funds, as universal, compulsory and trusted, need to deliver on members' best interests by considering the pension, superannuation, other private savings and home equity. I think to deliver best interests and best outcomes for most Australians, we will need to bring in the 3 pillars into some sort of coherent place, and I think that's likely to be delivered by the super fund.
But
The elephant in the room
that would require regulatory change, though, very specific.
Is best interests beyond super, and can intra-fund advice deliver best interests advice across 3 pillars? That is one of the elephants in the room.
Deb, do you agree that if you don't redefine or at least articulate what best interest is?
Yeah, and I didn't make it that clear enough. I'm sure that is the intention of the Cabinet, that you need to know these things across the 3 pillars. And we're just going to have to see the ability for that to be done, because otherwise it's kind of meaningless. You need to know if there's age pension income. You need to know if people are homeowners or not. Yeah, it's just a nonsense otherwise.
One of the issues that John raised earlier was the issue of engagement. And George, if I can ask you, I mean, this is something we've talked about in earlier panels. It's all very well to have the best advice available in the world, to have all the options on the table, but you've got to get people motivated and engaged. How do you actually do that?
That's a good question.
Isn't there an algorithm for that?
Yeah, well, I wish there was. It'd make it a whole lot easier.
Digital charisma.
Well, that's not me. I'm just going to need one. This is our experience. Most of the people that come to us don't know where to start. They come to us seeking to find someone to give them a solution, but they don't know where to start. So they're saying, well, should I start with my super? Should I start with my insurance? Or everybody's different. So our focus on this is to find out as much information about a client as possible. And this goes back to the issue that Stephen made before. We've got some information, we don't have all the information. And it's not a difficult thing to do to deliver a digital fact find or a questionnaire, let's call it, not a fact find, that gathers a lot of data about someone in a very short period of time. Could be 10 minutes, 15 minutes. You get a wealth of information about the client. So you'll know about their superannuation situation, insurance. Do they have a will? Do they need a will? Yes, they probably do. And all sorts of things about them. So then you can determine where are the gaps. And that's the starting point, to plug the gaps. So that at least they've got their super in place that's properly in the right investment vehicle, the right investment fund. They've got their insurances in place, whether it's inside or outside super combination. But people are looking for simple solutions, because most people have very simple needs. We're talking mass market now, not the potentially complex needs for self-managed super funds and the high net worth.
But you still have to get them to the point where they're prepared to come to you
Yeah.
and ask those questions. And Josh,
Yeah.
let me put it to you. How do you engage people, and particularly not people who are, about to retire, because the closer you get, the more engaged you are. This whole process needs to start earlier, doesn't it?
No. We've got 4 million people in retirement, and baby boomers coming into retirement. 250,000 new baby boomers enter retirement every year, joining 4 million who are already in retirement. So we can't say, the solution is to talk to 50-year-olds 15 years before they retire. The solution is to deliver to people at the point of retirement so they can have confidence in their long term. Our customers come to us then. They come to us 10 years into retirement when they're going onto the pension because their super is being eroded very quickly and they've still got another 20 years to live. And we see people who are coming to us at 85 or 90 moving into aged care. Our customers are triggered to come to us, not because they don't know where they need to start, because they have a very clear starting point. They have an acute need. They need aged care funding or in-home care. They've got to renovate the house so they can keep bringing the kids together for Christmas for the next 10 years in retirement. But from that starting point, they come to understand how much wealth they have left in their super, what their pension is over time, and what their home equity is. And then they can actually plan to allocate their wealth for the next part of their retirement. So the starting point is a need. Most Australian retirees are underfunded for retirement, and they also need housing for retirement. So there's no problem. The overall problem is awareness of home equity and integrated, coherent delivery of that as part of superannuation. And so coherent delivery came out in the Retirement Income Review, absolutely important, and awareness of people's wealth. Those two things I think will provide confidence.
So this is where we're talking about the different cohorts though. So that we've got the pre-retirees or the retired cohort, and they need specific advice. It can be sometimes complex advice. But then you're talking about people in that sort of grey area that I call that are coming out of the sort of wealth creation into pre-retirement that need, again, specific advice, a little bit more complex. You've got a whole raft of people that need advice, quite happy to get some form of advice at some stage and pay for it, and they're looking for solutions. So when I read the Retirement Income Covenant consultation paper and I think of cohorts, there's several different cohorts in my mind, and they all need different things at different times. The people that are pre-retired or retired obviously need a lot more complex advice, and that's a given, and they do need to go to advisors and people like Josh's business. But we look at the different cohorts and try and accommodate for most. But technology is not at the point where it can accommodate for very complex advice yet. I don't believe so.
Deb, let me ask you though, if we got better, and this is I suppose the bottom line, if we got better advice, would it change people's behaviour? How prepared are they to run down their super balance? How prepared are they to, after spending their entire life paying off a mortgage, access equity in their home? And I know in another place you've given me the statistic that 17% of people on an age pension own a home worth $1 million. I mean, why is that? Is that all about advice and access to product, or is there more than that going on?
Yeah, you know what's going on, and it's also about how you engage people, is that we've tended to think about retirement savings as a nest egg, and we reinforce that by constantly sending the information on balances to members over time, and people see this nest egg that's preserved. Mm-hmm. I'll spend the interest, I'll spend the dividends, I won't spend the capital. One of the things that has turned people on to connecting with their funds has been providing them instead with a retirement income projection. And all of a sudden people start to think differently. This is the money I've got to spend. And where that's been done, they're far more likely to engage with their fund and also more likely to make a voluntary contribution because they can see what the net effect of their superannuation savings is. So it's really part of it is that behavioural thing of changing it from being a nest egg view of your retirement savings where you preserve the capital to talking about retirement savings in terms of being an income stream. And that's going to take a while to do, but I think that's a really, really important part of reframing how people see their retirement. And that's that longevity component to let them know they're not going to run out of money. And then they also need to know about all of those benefits that are available to them throughout retirement. What's essentially the fourth pillar of retirement, which is the healthcare, aged care. It's very generous in Australia. In fact, in the report, we said that it's the equivalent of the full age pension every week to people over 65. There are a lot of benefits there, and people tend to be needlessly fearful of running out of money. So getting them to think about it in terms of an income stream and not a nest egg, and making sure people are better informed about the things that are available to them as they progress through retirement is really important to change that mindset.
And how, I mean, part of changing that mindset is certainly the messaging from the super fund. So how should they be doing things differently? Every time I get an update from my super fund, it's all about oh, you've got this much, or maybe a little bit less, depending on how the markets have gone, but it's all about that.
A little bit more. You've always got a little bit more, Ali. Yeah.
Well, that's that retirement income projection, and there's been some great research done over the last couple of years with CBUS actually, and it's proving to be very effective, and I think you'll find mentions of that in the covenant. We need to give people a feel for how well off they're going to be in retirement, and to think about it in terms of income, not capital.
Deb, I'll just say, I think you're absolutely right. A shift from a nest egg that's for preservation and bequest is essential. I don't think it's a shift just from a nest egg to an income. To live a good life for 30 years in Australia, you need access to income, but also capital for repairs, for contingent expenses as they come up. And then I think, to George's point, super plays very different roles for people at different levels of adequacy and different longevity. So a lot of Stephen's members in HESTA will be women with $70,000 to $140,000 in super at retirement. Now, the opportunity to generate a significant income on top of the pension from $70,000 in retirement is very small. The opportunity to grow $70,000 through 30 years to provide flexible access to forms of capital and credit that they can't get through loans, mortgages, credit cards, that can cover expenses that can't be met by the income they're on, the pension, is profound, both as longevity insurance and contingency funding insurance. If someone starts with $1 million in superannuation, an income approach is usually pretty good because they can get access to capital and they've got enough to make products out of it. So it is quite, I think the function of superannuation to provide retirement funding alongside the pension and home equity needs to be based on different types of outlooks for different people with different levels of principally adequacy amongst other cohort variants. It's not just income, but I think you're right, we've got to leave nest eggs behind and move to funding both income and capital, but make that specific to levels of adequacy. Otherwise it gets a little bit averaged out and there's no average retiree.
Stephen?
Yeah, look, I was just going to say, I think there's something in that. I think it's not a single point, right? This is not a sales point. When you retire at age 67, you go to the market and you get yourself a retirement solution. This, as Josh points out, it's different for every member. HESTA's members are typically nurses, midwives, aged care workers, early childhood educators. These are people, mostly female, in and out of the workforce. They don't have a lot. So their solution is quite different to someone who's getting a big annuities solution. But the conversation needs to happen at different points for different members. I can tell you, most 30-year-olds not thinking about super. They hit 45, a light switch comes on, they want to have a conversation, but they're not ready to have the home equity conversation that Josh is talking about. We need to gradually open them up to, well, what are the pieces that we need to consider, and what are the pieces that make sense for you? And that's not going to be one meeting. That's not like a series of 3 meetings. That's a continuous conversation.
Yeah.
And Stephen, that's also a conversation, isn't it? That, I mean, given most people are scared they're going to live forever and they'll never be able to afford anything, you know, in the latter years of their lives, you sort of have to have it. You have to bring in that fourth pillar as well, as Deb was talking about it, and you've got to give people a holistic view of what they'll be able to access, because that sort of accumulation focus has meant we've also focused on that's all we've got, you know.
Well,
yeah, no, you're spot on. You know, the only thing worse than dying young is living long. How am I going to afford that? So, and this is where, we have to, as funds, I agree with what was said before. We're at the heart of the solution somewhere. And a lot of it is not about solving it all by ourselves. It's actually by reaching out to partners who are on this conference and saying, how do we work together to put a member in touch with the right solution? And I will say that the government and the thinking behind this, I mean, Deb's report is just fantastic because it's opened us up and moved us away from, the SIPA's solution, which was all product driven. As George said, that's a bad idea. You don't start with the product. You start with the problem and try and figure out how do we create the basis for innovation so that we can get a member to avoid the wrong product and give themselves a chance.
And John, the self-managed funds, are they more, if you've got a self-managed super fund, are you more able to get your head around not having the nest egg focus?
Very good question. I think the answer at the moment would be there's still a lot of nest egg focus there, and up until recently, a lot of the simpler investment strategies, which could have been a high proportion of large listed Australian equities paying franked dividends and money in term deposits, gave a pretty secure income flow that didn't erode the capital. That's much more difficult now with interest rates close to zero, and there is a lot of focus on there's tens of billions of dollars sitting in cash and term deposits for people in their 60s, 70s, 80s. That probably makes less economic sense now than it did 5 or 10 years ago, and people are looking at how do they go about adjusting their investment strategies, and part of that conversation is recognising that the nest egg concept, while it might have worked well historically, it's not the ideal way to optimise people's futures if they do want to make sure they're living in dignity, and a lot of them will be sort of moving on to an age pension, and it's really at some stage of their retirement, so it's really a matter of optimising how they are going to draw down to that capital in a way they feel comfortable with. So it's a journey still in progress, but closer to the start than the finish, Sally.
George?
Well, I was going to say that I think the stats are that 1 in 5 people don't get to retirement age, 65 or 67, whatever it's going to be, because of ill health. So health is a really important part of any discussion.
They don't get there working, George.
Sorry? They don't get there working.
That's right.
Sorry.
Some people die before retirement age, but a lot of people stop working before retirement.
Because of ill health. Yeah. So, I mean, you talk to a timber worker, most of them probably don't get to 67 because they stop.
They can't physically work.
No, they can't. So there's a discussion to be had with people about their own particular situation. Again, a cohort discussion, if you like, about, well, how do you, the type of role you're having or the type of work you do, you may need to retire before 65 or 67, whatever it's going to be. So how do we fund for that? How are you going to live? What's the balance between putting money in a super and other things, as well as considering the pension as part of these sort of long-term income requirements?
And George, there are a lot of nurses and midwives working until their mid to late 70s because they can't afford to stop working,
right.
even if their bodies are screaming.
Yeah, that's right.
Can I ask you all a question, I guess, about government policy as well? Because when you look at superannuation and all the various pillars of retirement income, it's a lot has been put on the super funds at the moment, but there's also the issue of language and of how we perceive superannuation funds. Deb, in your view, and particularly if we look at this in a COVID environment where people were able to raid their super funds for help, what does that do to how people think about retirement funding?
Well, ironically, access to super through the COVID crisis has actually increased awareness, I think, of the importance of your super balance. And we actually saw a bit of that too during the global financial crisis. So I think that as balances are growing, people are more aware that this is a really important asset that they have. And I think it is becoming more centred in people's thinking. And that's the challenge to get that through. Did I answer your question? I've started thinking about that.
No, it did. And in fact, Stephen, do you agree? I mean, that's a real silver lining out of that early access to super.
Look, yes, never waste a good crisis. But I tell you, that's the most expensive engagement campaign in the history of financial services. The money that people took from their own super funds for early release is going to cost them more in retirement than anything they're likely to pay anyway. But let's just go back to the positive, which you've identified, which is it did create some engagement. It did have a whole lot of people listen to this feedback and say, hey, this dollar, this could double and double again. This is my future. And so yes, there was an upside to it that I think the really good super funds, and I think Hester's one of them, really used it to try and engage with their members and say, what are the responsible options you have in front of you now?
Of course, so that engagement, this dollar could be this dollar. It's accumulation.
Yeah. There's only one thing. Yeah, as long as people understand compounding, you've won the game, haven't you? Yeah. Compounding. Well, it's the thing we need to get across. Yeah.
Josh, what do you reckon?
I think our experience is that people will continue to discount their future, even with advice and engagement. And actually Australia as a system does well at having an awareness of superannuation, and we've got a real opportunity because we've got good healthcare and longevity. It's a challenge and a benefit. Got a good pension that's sustainable, means tested, higher for those who get it than offshore when everybody gets a flat pension. We've got good housing, residential property, and we've got a good superannuation system, but it's not there yet for baby boomers. We've got great home equity that we can add, and it's already been declared in a world-leading way as the third pillar. So funnily enough, Australia's got the chance to meet the challenge of an ageing population with the existing componentry and the wealth that we've already saved. The strangest things, and it was on another panel in this forum, Australians are the wealthiest retirees in the world, okay? At a median level, not even average, median level. And we tipped over the Swiss. The Swiss have most of their assets in, index funds and gold, very gnomish Swiss. We've got it mostly in home equity. But this panel needs to deliver wealth that Australians already have back to Australians quickly to meet their needs over the next coming decades. There's lots of those people. So I think awareness is part of that, awareness of super, but awareness of people's wealth more broadly is much more important. Otherwise, we're in a little burrow of awareness of something that isn't enough to fund retirement. But Australians do have enough to fund retirement if they're aware of all three pillars, and if we as an industry can deliver it quickly. So I think there's a bigger picture. I think the retirement income review, to what Stephen said, to Deb's great credit, really did generate that awareness at a B2B level. The challenge now is to take that to members and customers so that we get national awareness of our wealth and we use the tools we've already got to deliver it. So I think at a policy level, the hard yards have been done. Australia has saved, and baby boomers are really saved. We've just got to get back to them.
But in terms of changing that perception of people that the hard yards haven't been done, everything that we see, all the ads for the super funds which talk about accumulation, all the reviews into superannuation, all the discussion about the fact that so many people don't have enough super, all the numbers that are being done, all of it goes against we're the wealthiest retirees in the world. Sure. So it's a complete, we almost need a complete game-changing perspective on it, don't we?
Yeah, we've done a great job at helping people be aware of superannuation. It doesn't help 5 million people who are at or in retirement now because they got 3% 30 years ago, halfway through their working careers. So the whole game about in 20 years' time, retirees will be in a different level of savings and home equity. It's still a conversation that is 20 years too late for the people in need now who don't have enough in super. So a conversation that focuses on super misses the next 20 years of need. So we've got to change the conversation and have broader awareness.
The wealth, though, is in the home.
The wealth's in the home, and in the Australian pension provides an enormous risk mitigant for longevity and income.
We agree.
So the pillars are there, and the wealth is there.
Yeah, we try and balance it might pay you not to put as much in super, reality, because you'll get more of a pension and the benefits that go with that. And then you've got to balance up, super, pension, home equity and savings. that's the next stage of the modelling.
Seems to me there's a lot to be done around messaging around, across the board. But let me draw this panel to a close by asking each of you, and we've discussed various things, but maybe just in very basic terms, if we were going to look 5 years ahead, what is the one thing that we can do in that time frame? And as Josh said, we don't need to reinvent the wheel. What can we do that will mean that retirees in 2026 are living wealthier on their own savings than they are in 2021? Stephen?
Wow. Again, you ask an obvious question, Ali. I think it's not a less than obvious answer. I think the main thing is about engagement. You need to somehow find a way to connect with members and talk about these challenges with their language. I think too often we revert to some deep fin review type coverage and experience and say, look at all these really complicated numbers. And that just drives fear. I think if you want to have an optimistic retiree base, you actually have to start framing the conversation in words, concept, numbers that they understand. And I think that'll drive the best sorts of outcomes.
John, I mean, of course, you're coming from a slightly different perspective, but from a self-funded point of view?
The two things I would put together would be we need a better financial advice regulatory system, which the hard work will be done next year, but that does need to marry up with digital advice capability so that people can get access to advice with digital support, but dealing with people as well, and that it's done in a safe, secure, trusted environment, but doesn't lead to very lengthy disclosure and regulatory documents that are not adding any value to the customer. They're just providing a paper trail for essentially the regulator and others to sort of look at the process from outside. And we need something that's really going to work for people. We call it a consumer-centric advice framework with digital advice support, and that's what I'd love to see. Shorter than 5 years, but it's probably going to take most of 5 years to get there.
George?
I just echo John's sentiments in the main, but I think you need digital and some human involvement. Yeah, I think for pre-retirees and the retirees, you will need a combination of both. As I said before, digital can't do it all yet. It's getting there, and I know it's getting there, but you will need some form of advisor interaction. But the big thing is to give people access to affordable advice. That will make a huge difference. Yeah.
Josh?
5 years' time, every retiree in Australia should have at least annual access to digital advice that makes sure they get the pension as soon as they retire, and throughout retirement have access to the full entitlements of their pension and other government entitlements. That's a huge value stream. That should be delivered by superannuation funds in one point. That same digital advice should make sure that their superannuation account, which will be the third and the smallest part of their retirement, is well managed with the right products. And thirdly, if they have access to their available home equity annually throughout retirement to draw down responsibly, that can deliver an additional $10 billion a year over the next 5 years to the Australian retirement sector and the Australian economy. We can stimulate the economy, we can make people have access to their wealth, we can give them confidence every year for 30 years in retirement. That's doable in 5 years. We've got the technologies now. I think it starts with superannuation funds going that journey because they are universal, compulsory and trusted to deliver that.
Deb, let me give you the last word.
I'm not sure if I deserve it because I'm going to repeat what they've already said. I do think engagement is at the heart of the retirement covenant, and people trust their super funds. That's incredibly important. And as George said earlier, of course, people will always get advice. Higher income people will pay $5,000 a year, not think twice about it. But it's the majority of people on lower incomes who need that affordable, cost-effective advice, and super funds are the trusted vehicle to do that. I think the rules around advice very much need a review, and that's in everybody's interest to do that. So I think our panel have got it beautifully. And I think actually when you look at the surveys, you can see that people are aware of housing now, not just as a home, but also as a source of wealth. They're also less likely to focus on bequests, and they're more likely to want a good quality retirement. Our baby boomers coming through are nowhere near as frugal as past generations have been, and they want to know a way that they can have a really good quality retirement. So I think, in a way, the whole stage is set for us moving through into a better retirement income system.
Well, I think that you've all of you have set the stage, and you've also pretty much written the play as well. So now let's just hope that it gets carried through. An enormous thank you to all of you, to Stephen, to John, to Deb, and to George, and to Josh. Thank you very much for joining us.
Thank you.
Thank you.
Thanks,
Thank
Ali.
you.